We have about 1 billion in transaction volume and about $500 million in AUM. But all these numbers, they don't mean much unless you have investors that are actually happy, they trust you, they like you. And that's our main goal, is to really work with investors and treat them. Everyone is being treated the same, whether it's a $50,000 investor.
Tim is one of the most authentic and genuine people I've ever met.
I sincerely believe he's coming from a position of giving, and that means a lot.
You're going to make huge progress.
Welcome to the Capital Raising Show. I'm your host, Tim Mai. And today I have an amazing guest speaker, expert syndicator that we have on the line with us today, Miss Ellie Perlman. Ellie is the founder of Blue Lake Capital Group and has over 15 years of experience in real estate investments, law, and property management. Blue Lake Capital owns and manages over 3,300 multifamily across the U.S. And Ellie started her career in Israel as a commercial real estate lawyer, leading real estate transactions for Israel's largest development company, and later became the property manager for one of Israel's most prominent oil and gas companies, where she oversaw an extensive portfolio of properties. Ellie holds an MBA from MIT Sloan School of Management, bachelor's and master's in law from Bar Ilan University in Israel, as well as a bachelor degree in law. In addition to that, Ellie is also a long-term Forbes author on real estate investing. So let's give Ellie a big welcome, y'all.
Yay. Hi, thank you. Thank you, Tim, for having me. It's great meeting everyone. Thank you.
Yeah, awesome. Okay, Ellie, let's start out. If you can share with us a little bit about your background and especially why and how you decide to get into this real estate syndication space.
Yeah, absolutely. And I apologize for the lighting. I'm sitting by the window and it's actually a beautiful day, but the lighting is coming in and out. So yeah, I think actually the numbers that you have are a bit outdated because we've exited about half of our portfolio in the last, I think 18 months or so. We have, so Blue Lake is a company that I founded in 2017. We have about 1 billion in transaction volume and about $500 million in AUM. But all these numbers, they don't mean much unless you have investors that are actually happy and that, they trust you, they like you. And that's our main goal, is to really work with investors and treat them. Everyone is being treated the same, whether it's a $50,000 investor or $5 million investor. I think our biggest one, I want to say, is probably a JV partner of 25 million. But usually our investors, the smallest check is 50,000 all the way to, I want to say 10 million would probably be the largest one. And yeah, I mean, we're buying multifamily assets, usually 300 to 500 units, Class B, light value add in the Sunbelt area. So I'm sure like many of you are doing as well. And yeah, we have an office in Boston, an office in Los Angeles, and we do everything in-house, from acquisitions to asset management to capital raise. We do it all. And our goal is to grow the portfolio and to be the number one company that provides the best experience to investors.
That's phenomenal. And I love, we're going to circle around what you said about you exited half of your portfolio in the last 18 months, which is perfect timing, as good as it can get. And so we'll go into that a little bit here, but what got you into this syndication space?
That's a very interesting question because there's so many other avenues to get involved in real estate. I actually grew up poor, and it was a very painful realization where I was. Kids are great, and I'm a mom myself, but they can be very brutal by telling you, you're the poorest, and we want to have, we don't want to be associated with you. And so I was driven from a very young age to not be poor anymore, to be wealthy, to get out of that cycle of poverty, but I didn't know how. And what I saw around me were families, wealthy families involved. They were all involved in real estate. I chose syndication because I didn't have money to buy single family homes and flip them, or execute a buy and hold strategy. And I said, you know what, I'll start syndicating deals and I'll work with investors who have money. I had time, they had, money. And that's how I got involved in syndication, because I did not, I didn't have the money to invest, and I wanted to scale. And I understood that that was the way, to scale and grow a company. And coming from MIT, when I built Blue Lake, I built it as a startup, as a company with all the tools and the infrastructure needed to scale. And that's how, I approached it. So that's how I ended up in a syndication.
Gotcha. Okay. I know it's only been what, 6 years, right? That since you've been, and I mean,
6-7 years. Yeah.
yeah, 6-7 years, to now have done, over like $1 billion in transaction. That's huge. Share with us, how were you able to achieve that kind of growth in such a short amount of time?
I have to say that there are other companies that have grown much faster than this, and they've bought it in a shorter period of time. And I think we were actually buying slow times, because a lot of the deals depends economic sense, and we're pretty conservative on underwriting. Growing in that, in you can say that in 6 or 7 years, that for me it's not quick. It actually took more time than I thought. But the way to do it is really to focus on, not focusing on the next deal and how much money I'm making there, but look at the entire picture and say, okay, what is my real goal? My goal is to build a company. Where do I want to be in 10 years, and scale back from there, and, have a solid business plan and understand what do I need to do today in order to be where I want to be in 10 years. Build a plan for the next 5, and hard to build this business plan beyond 5 years, even though it's important to keep in mind where you want to be in 10 years. And then after you did, you did some reverse engineering, really, you can start building the backbones of your business, and understanding, okay, these are the people that I need to have today in order to build this. So not try and do it all to save money, because the deals that you're going to lose, and the economic, the carry and the fees that you're going to lose are going to be much higher than any $75,000 employee that you're not going to hire. So, I took a loan to start my business, and it was the best thing I've done. I did not try and do it all, on my own. And I hired people to help me, and that's why I am where I am. And I still haven't gotten, to where I want to get to, but I was only able to achieve so much because I had a really, really strong team.
I see. Okay. And then in Blue Lake Capital Group, how many partners do you have? 0. Oh, wow. See, that's the thing. Like, it's one thing for, I've seen and some of the operators I've interviewed where they have 2-3 partners, and they grew at the level that which you grew. For you to grow all this by yourself, yes, you have a team, but in
Yes
terms
and
of
no.
partnership, yes. Yeah.
Yes and
Well,
no. I have a very, very strong JV partner that I'm working with. But in terms of Blue Lake itself, I don't have, any partners. And, you always need to hire or partner. So I've decided that for the most, I would say, tasks and needs for my business, I'm just going to hire. And as a business owner, I think it's a savvy decision, because you get to keep most of the economic upside. but it's
Right.
hard. I'm not gonna lie. There's some, times where having one or two partners by your side can be very helpful. And I don't always have that. So
Right.
I think the emotional burden, I mean, running a business is an extremely, extremely stressful, operations, especially if you want to scale. You can build it as a lifestyle company, and then, you can work 3 hours a day, and it's totally fine if this is what you want to do. For me, I wanted to, the challenges are exciting to me. And I always want to achieve something bigger than what I can currently achieve. And then once I get there, I'm always looking up and trying to achieve the next goal and the next goal. And I had a mentor back in Israel that told me you have to stop and smell the roses. You have to pause and enjoy um the benefits and the successes that you have. And I told him, teach me how to do it, because I don't know how to do it. So not having partners it is challenging, but there's pros and cons to, everything. It's also, one of the biggest pros is that you don't need to convince anyone. If you want to take the business to a certain direction, they're buying. You to consult with them and get, their approval. And if you need to inject money in the company, there's no, it's essentially you don't need to convince anyone to do the same. Their cash flow situation may not be the same. So it's there's pros and cons, but I definitely did not get to where I am by myself. I have really, really great team. They're smarter than me. They're quality people that really care about our investors. And those who did not just didn't stay with us. And I have a very, very strong JV partner, Vina Jetty, which, I work with from Vive Funds. So that combination we both found to be, very powerful.
Gotcha. Okay. So the two of you work side by side on a lot of deals together. Is that correct? Your company and her
Yeah,
company?
and we both have the freedom to choose if we want to do a certain deal or not. And that's the freedom that we wanted to maintain. So in a sense, if I decide to start a certain fund or to go and purchase a certain deal that does not work for her, it's no hard feeling. And we've done it before. We like working together, but I also maintain the flexibility of being the only partner, not one woman show, but the only partner or the only owner in my company.
Right. I like that. That's a very good business model. So share with us about your business model. Are you, do you source your own deals, or do you partner with others who source the deals? You operate the deals? Like, what are some of the core activities that you do in your business?
So we do it all. We're a one-stop shop. I have a very strong acquisitions team. We source a lot of deals. These are right now very special times where we actually get many, many phone calls from brokers about off-market deals, and those sellers that sold us off-market deals are offering us more and more deals, and then they're referring us to others that are thinking to sell off-market. So it's very interesting. So my team actually flies across the country, they're walking assets, they're coming back with some insights, underwriting deals, and then we also and once we get a deal under contract, we have an investor relations team that helps raising money from our investors. And we do work with funds also. We have a very attractive fund of fund model. And they're always busy because right now we have a fund that is still open, and so they always there's always something for them to do. It's a very, very busy team. And once the deal's closed, then the asset management team is managing the asset. Often they're visiting the asset at least once a month, if not more often, sitting down with the property management team, the construction team every week, to review progress and to tweak the business plan as needed. And that's it. And when we decide to exit, then again, acquisitions is getting involved. They're essentially driving the process And so we essentially do everything in-house.
Gotcha. Okay. And then the funds you mentioned, share with us about that. Yeah.
Yeah, absolutely. So the fund is essentially a multifamily fund, and so we're purchasing assets across the U.S. And this is something that we've done before. We're buying a Class B, light to moderate value add, and then we're renovating the exterior. We're the units and putting new management in place. And we plan to hold the assets for about 5 years. And if it's the right time, and we think that it's actually more prudent to exit early. If we can hit the projected returns, then that's what we're going to do. But generally speaking, the fund is a 5-year fund, 5-year hold fund. And that's the fund that it's called the Blue Lake Multifamily Fund. And we have a pretty unique model because essentially the bigger you invest, the more you get to keep as portion of the sales proceeds. So everyone in the fund is getting an 8% preferred return, which we know is above.
Yeah, you know that the 8 pref is above the market. Okay.
Yeah, we know that 8 pref is above market, but we wanted to create a fund that will give new investors an opportunity to get to know us. And essentially, the more you invest, the more you keep the portion that you get to keep after assets are starting to get to after we start exiting deals in the fund, then you keep a bigger portion of the sales proceeds. And so, essentially, without getting too much into the weeds of it, we're projecting an average of 15 to 16.4% IRR. And it might sound a bit higher, but that's because we're willing to share some of our GP economics with investors, meaning we're essentially letting investors keep more of what we normally would have paid the managers as part of the exit. We have that fund, and it's, I would say, tool to diversify your portfolio and risk. And we're planning on buying. We have one asset right now in the fund. Buy the next asset before the end of the year, and really we're using an AI-backed technology to identify the right submarkets, to essentially improve operations. And so at the property level. And so it's very exciting, for us to be using those tools, because I know that in many cases, when a team underwrites a deal, they're using 3 or 2 or 4% vacancy, or they pick a random number for rent growth. And especially in today's market, when we all know that rents are softening, we need to take emotions out of the investment process, and we need to let technology and data speak to us. And that's what I've learned from my time at MIT. And that's what we're using, an AI-backed technology to essentially analyze the asset's performance and to share what is going to be the concessions, the occupancy and rent growth at the property level compared to what's happening in the US, in the submarket, and at the property itself. So there's so many data points that the software analyzes, and we're either using that number or numbers that are more conservative AI is showing us. And that's what's unique about how my team is actually underwriting, because we really rely on AI and hard data to make investment decisions.
Very cool. Yeah. This fund, and I'm actually on your website right now, I see this is $100 million fund. Is it a blind pool fund, and is it an open-ended fund?
So it's a blind pool in a sense. Investors cannot choose which assets the money they've invested is going to go to, because it's going into a fund. It's a closed-end fund, meaning once we're selling an asset, we're taking the sale proceeds and we're not reinvesting it in the fund and buying more assets, but we're returning it to investors. So they're going to get distributions once as sales are happening. And 18 months from now, 5 years from now, I would say, we have to be I would say 2 to 3 years was pretty unusual. So I would not expect to exit after 18 months. I would expect to hold an asset for at least 4 to 5 years. I think we're going to go close to the original business plan in terms of, holding the assets for probably close to 5 years.
Gotcha. Okay. So when you first launched this fund, um, did you, like, as you were raising money for the fund, you deploy that money into assets, correct? You didn't like wait until you raise 100 million before you deploy. Is
Yeah,
that
and
correct?
I'm happy that you're asking this question, because one of the things that we were concerned about is, okay, if investors are wiring funds, what are we going to do with the money while we're looking for deals? So we do have this, we found a creative solution. While the money is waiting to be deployed, it's actually being invested in a money market account. And we're getting over 5% from the institution that we're investing with. And we're not taking anything, we're passing all of it to investors. So as your money is waiting, or it's actually making money, we're always either under contract or actively searching for the next deal. So it's not going to sit there for 6 months. But while it's sitting there, it's actually making money. And it's this account that we're investing in has a daily liquidity. So whenever we need it, we can actually move the money out of that account. And it's great for investors because them to get interest on a daily, essentially a liquid investment. So it's a pretty unique advantage that we offer, our investors.
Gotcha. Very cool. And then you had mentioned that you have a pretty attractive fund of funds model for the fund of funds to help you raise. Do you have a minimum that you want the fund of funds to invest into your fund?
So when it comes to other funds, we also have deals that we're raising, aside from the multifamily fund, that they can come in and invest directly in that deal. And for many funds, it's easier that way because they can look at the deal, they can vet the fundamentals, and they feel more comfortable with it. We do have an attractive model for groups, and it can be fund, be an individual, can be family offices. For us, it doesn't really matter. We're looking at the size of the investment. And so if, at a minimum of 500,000, we actually can provide a certain share class. And the way that it works I actually haven't seen anyone else, really doing it in the market. And it's a bit complicated, so bear with me. And because it took us time to make sure that we fully in how everything works. And so essentially, there are two components to larger checks. And when I say larger checks, I mean 500,000 and above. And we created it because we found that investors that used to write $250,000 checks, once we offer them extra benefits, they actually bumped it up and they started writing $500,000 checks. And that really allowed us, it built our raising abilities, and it helped us buy assets that were 80 million, 120, 100. I think our biggest one was 131 million that we bought recently. Essentially, there are a few components. One is the share price. And so we do provide a 3% share discount. And what it means is essentially if an investor is wiring 900, I'm going to use $1 million example because it's just easier. $970,000 wire, they're writing us that check, or they're owning shares worth of $1 million. So when it comes to calculating the pref calculus or share of the entire investor community on the back end, it's as if they wired $1 million. So some of them wire 970, some of them wire all million because they want that million plus, 3%. Right. But that's one benefit that we offer to funds and larger investors. And family also really like that structure. In addition, we call them Class D. So we have a few share classes. In addition, they're getting every month up to 2% of their pro rata share of the income of the asset. So these are not huge amounts, but it's, let's say if someone is half of the equity, so it's 2% of half property's income every month. And when we're selling the asset, they're going to receive another 20% of their share of the returns. So it's essentially another check that they're getting on the back end. And so that's something that many funds also, like, and what they do with that, it's totally up to them. For those investors that are $500,000 and above, we're talking about over 2%, over 2x of equity multiple, an average of 7.24% cash on cash, and about 17% IRR net to them. And when I say net, I mean after, all of our fees and everything. So talking about 17%. And of course, if there are checks that are, usually beyond $1 million, if we're looking at 2, 5, 7, then it's on a case by case basis, and we can definitely have a conversation. But we found that combination of share discount on share price and additional 20% increase on their sale proceeds at the end was a very successful model. And I can share that we have one family office that I think they invested, I forget if it was 5 or 7 million. I don't remember the exact number. They made over 70, I think it was 72% IRR net.
That's
because
awesome.
they got the additional check when we sold the asset. Investors made a 45% IRR, and these guys made 72% because they were the biggest investor, and we just gave them more of our share. So it doesn't really hurt other investors. It means that we are getting paid less, and I'm
Right.
okay with it because that means that I can move to the next asset.
Right. That's really awesome. And I love the way you're setting up your funds for the fund of funds managers. Can you share with us today, since you got into the syndication space, roughly about how much you have raised?
Oh boy. I mean, the last deal we closed is 66 million. I mean, it's north of, I'm assuming 250, but I honestly didn't really, and I should track it. But I think it was about, with our JV partners, I think it was about 200 and probably 250, around that number.
That's awesome. Do you still remember what your first raise was like?
Oh yeah.
Share with
Yes.
us.
I actually knew nobody with money in the US because I moved here in 2014. I went to MIT. Most of my classmates, some of them came from wealthy families, but they were all, some of them were still paying student loans, and I was one of those, students that didn't come from money. So I had to pay my student loan $180,000. So I didn't know anyone with money. And I actually went to my father-in-law, who has been investing in real estate as a passive investor. And I said, hey, Mark, I'm starting this new thing, and I want you to be my first investor. And I'm never going to forget it. He looks at me, and we're sitting in his kitchen, and he's saying, well, I'm investing with so-and-so, and they've made me a lot of money over the years, and they have, I think they were 5 billion in AUM at the time. Why
Right.
would I invest with you? And I said, he's also a business owner. And I said, Mark, when you started your business, you were me at that time. There were a lot of big guys, and that did not deter you, and it didn't scare you. And I told him, one day I'm gonna marry your son, and I'm gonna have an empire. I'm gonna have 2 kids. One of them is gonna run your empire, and one of them is gonna run mine. I would love you to be part of this, and help me out. And if not, that's also fine. But I'm telling this is what's gonna happen. So he was a bit shocked because it was very direct.
Yeah.
And he asked me to think think about it. And the next morning came down the stairs and said, okay, I'll invest with you. That was $250,000. And that was my first, raise. That was my first investor. But
Wow.
it wasn't easy. It wasn't easy. I had to go back and prove myself time and time again. And I appreciate that he did it, because I don't want anyone to do me any favors. I didn't want to
Mhm.
get any investor because they felt like they knew me and they didn't
Right.
feel comfortable saying no. And I started, building an online presence, and started writing blogs and hosting a podcast and being on other podcasts as a guest speaker. And people started listening to what I had to say and started reaching out. Some of those early investors are my friends today. And that's how one check after another. I think my first raise was slightly, lower. I didn't hit $1 million, was around $1 million. That was the first raise. And then it was no, I'm sorry. Then it was $1.5 million. Then the next deal was 8 million. And then it was 25
Wow.
or something like that.
Wow. You jumped fast to go from
I
million to
invested
8
in
million. To...
people. Yeah, I invested in people and they helped me. Otherwise, I think I would still, I had different JV partners that I don't work with anymore, but we combined forces. We really combined forces. And that's my advice to those who are trying. And right now it's harder to raise money than it was 3 years ago, 4 years ago. I always found those that are in place, in a place in their career and their companies where I wanted to be. And I connected with them and I learned from them. And gotta kill the ego. It would definitely slow you down. You get the ego out of the equation and you're gonna achieve, great things. And that's what I did.
That's amazing. I love that. So you had mentioned earlier that in the last 18 months, you've exit out, like half of your portfolio already. So share with us, how did you time the market, if quote unquote? How did you know that it was time to exit out of those properties?
I didn't time the market. And I don't be in a stock market, right now, looking at how my company is going public and exploding. But I felt like it's very good and the music is about to stop. I didn't know when. And
Mm,
actually contact with CBRE tried when we wanted to exit our Atlanta portfolio. He said, don't, just wait. Nothing is going to change next year. And I told him, no, 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 no. Know that if I'm going to exit right now, my investors are going to make a lot of money. And this is the right time. I don't see a reason to wait. And he said, I don't see the rush. And I insisted. And we had great, exits. I don't think, I definitely did not know. I couldn't time the market. I didn't know how, because I'm conservative in nature. My preference was to exit today. 40% IR, you don't walk away from it. Rather than wait for, if I had waited 6-8 months, there was no way I could have sold the asset close to that. So I think it's a little bit of a gut feeling. I thought about investors and them for going that, but I can actually make a nice profit from them. And then we can put that money into a 1031 exchange. So now someone who has invested, say 100,000 now has 150,000, for example, 180. So now that's the base of his next investment. And for me, it was just a no brainer. And I've
right.
seen groups overpaying, because I lost a lot of deals because I got overbid by $5 million on a
Oh,
75
wow.
million deal. These numbers, I realized that, okay, I'm losing many deals because I'm unwilling to overpay. But what is the positive, the bright side of the story? The glass half full is that these people can overbid on my assets. So now I can exit it to those groups. And that's what I did.
That is phenomenal. Wow. Share what have you had any deals that you had challenges with, especially like you had a capital call or close to it?
No, no capital calls. I think if there are any funds or passive investors listening right now, it's really important to understand how strong is the operations and liquidity of the sponsor, and not just the track record. So we haven't had any capital calls. Hopefully, we're never going to have to do it. But challenges, yeah, on almost every deal. I mean, I had a deal where when we put it under contract, occupancy was 98%. 5 days before closing, it was 72,
Oh, wow.
because the seller hid it from us, and the lender was calling me pretty alarmed. And now it was a Fannie Mae loan, and Fannie Mae was not willing to fund it because it's not stabilized. And the seller was hiding it from us, so we did not know until very close to closing. So yeah, that was very stressful, and we were able to work it out. We were actually able to convince Fannie Mae to keep the loan, but we had to communicate with investors and say, hey, this is the situation right now with occupancy. Here's our plan. And I actually went there to Atlanta, and I lived close to the property for about a week or so until we figured a plan out. And we were able to increase occupancy to 90%, and I think it took us 45 days, but it was very stressful. A lot of challenges from investors that actually did not make it into an investment because we were overcommitted. So how do you deal with that? How do you keep them happy and not upset? There's always, I don't even know if there was one deal that went exactly like we planned. There were easier deals, and it's mainly because we were lucky to have an easy and honest seller. That makes all the difference in the world. And usually if the seller is good and honest, there are fewer, hiccups along the way.
Gotcha. Wow. You had mentioned that a lot of your properties are between 300 to 500 units. These are huge, especially Class Bs and As as well, I assume, or?
We're looking into it,
Okay.
but mainly Class B.
Yeah, Class Bs, 300 to 500. Still, it's like huge properties. And did you start out with smaller properties, and then somewhere along the way you're like, you know what, these bigger properties make more sense? Or how did you come into focusing on that upper tier?
My first deal was actually pretty large, but I did not bring 100% of the equity. As I took a bigger role and raised, most of the funds, well, the deals were smaller at first. I think, one of the deals that I bought was 13 million, or 12.5, and then 20, and then a portfolio for 20 million, and then it went from 20 to 80 million. One of the things that I've done was, just believing that I can do something. And I saw the opportunity. The largest deal that I've done was an $80 million deal that we were awarded around May or June of 2020. No one was buying real estate. People were so scared.
Yep.
Institutions were on the sidelines, which, I think it's what's happening right now is similar to 2020, where institutions are going to be deploying capital, and then Q1, maybe Q2 of 2024, then cap rates are going to compress again. But nobody was buying, and lenders were also not sure what to do. And we had a seller that wanted to sell, and there were many buyers. And I saw an opportunity, and I know that I need to grab this opportunity, and in both hands. And that's what I did. And I just, said, we're going to figure it out. And we have. we were able to raise money, and later we sold that asset, and it was a fantastic deal. But you don't always know how things are going to happen when you're doing something that is, bigger than what you think, or what you've experienced so far. And I read somewhere that what separates those who are successful than those who are not is that those who are successful are many times willing to take the risk and have a leap of faith and work really hard, of course, to make sure that
Yep.
it's going to work out. That others do not. And listen, some of the things can be scary and uncomfortable, but I know that when I'm uncomfortable, I'm actually making progress. Otherwise, it's I don't know, it's not exciting. That's how I see
Right.
it. But it comes
That's
with a price. That's I have to admit.
I love it. Obviously, you have a multifamily fund. So, what's your outlook on multifamily? Are you still pretty bullish with multifamily in this next few years?
Yeah, I'm bullish, but with a caveat. So I think there are two main things that are the main focus when you're looking at multifamily. I think so. First of all, the demand is not going is not has it's still very strong. People cannot afford to buy their homes today more than ever. You have a lot of internal mobility within the U.S., mainly from California, still from New York to other parts in the Sun Belt region. But I do think that there are two things that are they're deal breakers for us when we're looking at any deal. One is the debt structure. So we make sure we're taking fixed rate, mostly agency, but very reasonable debt. So with any fluctuations, we don't need to deal with debt payments that go from 100 to 200,000 and wipe out the entire cash flow. The second thing is the strength of the tenant base. It's even more important than the location. We want to make sure that the assets that we're buying actually have very boring, tenant base. So those who do not skip in the middle of the night, so we're looking for very low delinquencies. So people who are actually paying on time, recession resilient jobs. So education, medical, some tech. Well, right now it's a bit different. But that's what we're looking for. We want to make sure that the investments that we're involved with are exciting, but also boring. So they're exciting because we see the opportunity. And the management can be not great, and we can bring great management. The asset is beautiful, but the interiors are outdated, and we need to invest in that and push rents. And but it needs to be boring in a sense that we don't want any more exciting assets where people escape in the middle of the night with some of the fridges and some of the microwaves, like I've had on another asset that I've sold, thank God. But yeah, so that's what we're looking for, those solid investments. I'm investing my money in every deal, and if it's not, and I'm one of the biggest investments in any asset. So I don't just write $50,000 check. It's a much more it's a significant amount, because I believe in my deals. So I grow my wealth by investing in my deals. And if I don't feel comfortable in writing a big check, then I don't bring it to investors. I pass on the opportunity. And my family invests alongside, with me. So that's what we're looking for.
That is very good. Yeah, that's super, super important. Like you said earlier, it's not just the operator's track record, but their resources and them, like in this case, big significant amounts of skin in the game as well. So that's really good. All right, so switch gear a little bit. What are some of your favorite tools that you use in your business?
Ooh, there's so many. I love tech. We do use Axiometrics. That's the AI-backed technology that we're using to basically understand how the asset is positioned compared to the comps and what would be the projections. I like Viva Goals, which is an OKR system at the corporate level. So it's KPIs, objectives and key results, and it's the equivalent of a KPI where we set goals for each team and then we measure those goals every quarter. And I love Airtable. Airtable is kind of a project management tool that is based on Excel, but you can create a lot of processes and you can store data this way. So, you know, and automate it. So once essentially team members can be notified once certain entry is filled in a certain cell. So that's, you know, there are many more that we're using from Slack, you know, obviously Zoom, but I think, you know, Viva Goals, Axiometrics, and Airtable are my top 3.
Awesome. For the people that want to reach out to you, connect with you, invest with you, partner with you somehow, where would you like to send them?
Yeah, absolutely. If you would like to invest, talk about the fund or about the opportunity that we have open right now as a direct investment, you can email info@bluelake-capital.com, and you can mention that you heard me speaking and would love to connect and talk. And then my assistant Rachel can essentially pair you with the right person. And so, and of course, if you want to chat with me directly, you can also ask to do that. So that's the email address. That's the best way to reach out to us. You can also go to our website, bluelake-capital.com. There's a lot of free resources to investors and to funds on the website. So there's also an investor forum that you can fill out, set up a call with Jeanette Robinson, who's our amazing investor relations director.
Ellie, thank you so much for doing this interview with me. I so greatly appreciate you. You've shared a ton with us. My biggest takeaway from our interview today is that, like, this kind of growth, the kind of growth that you have been able to accomplish is so possible. And, you know, and I love the business model of being partners without being partners. You each having your own company, but you still work closely together to leverage each other's strengths and resources. I love that. Thank you so much for doing this interview with me today.
Absolutely. And it was great, you know, being here and sharing, you know, my story and kind of talking about what I do. I can do it all day. So I think it's a good time. It's a kind of a good segue to the Q&A. But thank you for having me, Tim.
Thank you.